Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, June 29th, 4:26 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market continued to be in an uptrend, as you see over here in the upper right at the trend gauge. Market leaders acting just fine. And all three time frames that we track across the major indexes also acting fine. We're marked bullish or uptrend there. That's using the short-term 21-day exponential moving average, the medium-term 50-day moving average, and the long-term 200-day moving average relative to the 5 indexes that we discuss in every video. Why do we discuss the indexes? Because 75% of stocks will track what the overall market is doing. So we track the indexes, then we track sectors, we drill down to industry groups, and we look for the leading stocks in those industry groups, as long as market action is healthy and leaders are offering good risk to reward points. So recent action, what just happened today? Solid price action into the end of the second quarter, 1 day left. Maybe some window dressing going on, but regardless, leading stocks continue to hold up very well. And a couple new leaders coming to the fore. Always like to see the NASDAQ 100 leading. It actually started out lagging today as interest rates were up pre-market, but as they dropped as the day went on, money flowed into the NASDAQ 100 and out of banks and oils. So you can see S&P up just a fraction and Dow up just a fraction. Mid caps down 0.2, Russell 2000 down 0.6. They led early. The Dow and the Russell led early, but again, as interest rates came off and banks and oils reversed, we saw money flow into the NASDAQ 100 and semiconductors, and some leaders that were down early made some nice comebacks. So all in all, solid price action going into the end of the second quarter tomorrow. So let's get to the charts. But first, let's take a look at the guys running Revere. As always, we would love to talk about our process where I talked about how we identify the market direction, then the sectors, then the stocks. We think that's the best way to stay in tune with the market. There's no reason why you have to be at the mercy of the market, getting hit with a major drawdown because the Fed isn't doing what the market wants it to, like Q4 in 2018 when we had a 20% sell-off, or COVID, they're down 34% in 4.5 weeks. We got our clients out very quickly. We gauged the direction and we place our clients' money in on the table when the wind is at our back and protect it when the wind is in our face. And if you're interested in more information on this, you can email any of us, Dan, Tim, Hunter, Alex, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. So let's get to the charts. Let me blow up this S&P 500 chart a little bit. You can see just really melting higher as the summer heat melts the USA. Reading a lot about high temperatures, but this is supposedly sell in May and go away. Maybe that'll kick in July. But so far, so good. We've had some tests of key moving averages, but when you're at all-time highs in the midst of summer, you can't really complain. So there's your S&P 500. Let's take a look at the leading index right now, the NASDAQ 100, that it really has gone from laggard to leader, lagging big time back here from the middle of February till the middle of May, resumed its leadership position starting here on May 19th at all-time highs. Just great action and leading stocks going along for the ride also. Here's the Dow Jones Industrial Average. Always goes through periods of underperformance and outperformance. And you can see here, but it did get back above the key 21-day and 50-day moving average. The 21 is the green line, the 50-day is the red line. Strong move last week for the Dow Jones Industrial Average, now consolidating those gains a little bit as it rests right on top of the 21 and the 50. Let's take a look at the mid-cap index now. struggling just below the 21 and the 50. We give this one the least weight because it's 400 mid cap stock. So, but this is the incubator for the next big leader. So we certainly keep an eye on it. But from a index standpoint, we weight it less than the other four. And the Russell 2000 small cap. Let's take a look at that. Still in this big long range here for 73 days, came up to the top of it, pulled back for a couple days, sitting right on back of the 21. Let's go to the growth portion of this IWO. You can see the relative strength over the last 3 weeks on that as it flags above this recent breakout area above the 21-day exponential moving average. Let's look at the value portion of it, the IWN, and you can see how that, on the other hand, has been lagging for the last 3 weeks as it sits right on the 50-day moving average. We pay close attention to those. We also pay close attention to maybe the number one indicator of risk on or risk off. That's the ARC broad ETF. You can see how well that's been doing from a relative strength standpoint. Also the QQQJ. This is an index that's a mid-cap tech type index. Again, you want to see relative strength increasing on that, and we've also got that showing as it comes up to the top of its range. And we also keep an eye on the FFTY. This is the IBD 50 index. This has been choppy lately. Now, one of the things about this is this does not stay with pure growth names. This will rotate into some cyclical, so you'll get some choppy action on this as it rotates into some things and then they come out of favor. But all in all, it's a good flavor for what's going on with the leaders because it contains the leaders regardless of what sector they're in, and that's very similar to the way we do things also. So let's take a look at what I wanted to do let's take a look at a couple of indexes, sectors first of all, and see how they continue to be weak. The XLB basic materials, I talked last week about how with the infrastructure bill we saw a very brief flash of positive price action on new and NUE, which is a leading steel stock, and also CLF. But look what they did. They just bounced off their 50-day, ran into the declining 21, couldn't get over it, broke the 50 yesterday. We got stopped out on this for a very small loss. Same thing with CLF. Couldn't hold on to the 21. That's actually sitting on it right now, but it's flat and it's rolling over. When it broke below it yesterday, I sold both of them for a combined 0.2% loss. That's our R, the letter R, which stands for risk. And if you're not familiar with that concept, I'm going to talk about that in a little bit. So got out of those. We also took profits on FANG as energy has been overall weak. Let's take a look at XLE. Overall, on the weak side the last couple of days, there's an OPEC meeting going on, and there's speculation that they may increase production out of that. We don't want to be anywhere near the industry sector. If they open the oil spigots full throttle, we can certainly get back in whenever we need to. And also, I was in this NRGU ETF. Got stopped on that for 0.2% loss. And when I say 0.2%, that's on the overall portfolio. Again, that's our R number or our risk number. But when it broke below the 21, sold half yesterday, sold the other half today. Never really made any traction with this as it couldn't get above this 196.44 resistance area. Let's see. So that's what we got stopped out on. Sold FANG, stopped on NRGU, also took profits on QCLN. Why don't you let your winners run? Well, we treat ETFs a little bit differently. They're more like swing trades in here. This outperformed the S&P 7-1 during the less than 2-week holding period that we had it. And when it did this reversal today, this is the middle star of the middle candle of a potential evening star topping pattern. So locked up the gains on this. This was a +3 R trade. So that means we shoot for 2-to-1 gain to loss ratio. So this was a little just shy of 3-to-1. So we booked that, but it did outperform the S&P 7-to-1. You know that's not going to persist. So in a broad ETF like this, but energy looks good. TAN also acting very well. So let's talk about this concept of R right away, and let's talk about it in relation to one of the topics I brought up during the webinar that we had, and that's tracking what would the impact be to our portfolio if all of our stops got hit on the same day. So this is a list of our holdings, this column here, and this is where we bought them, when we bought them. This is the size that we bought them in. This is where the S&P was when we bought. So this is our stands for REBR, Revere Estimated Balance at Risk. So we want to know what our drawdown is going to be. And again, this is one of the big takeaways from the webinar that I did last month. So what we're trying to always accomplish is we want to outperform the S&P 2-to-1. So this is what the S&P has done since we made the buy versus what it's doing now. This column we always want to have a greater than sign. That means we're outperforming the S&P. You can see we've got one down here, ZIM, right down here, that is not outperforming, but we've got our stops in place for everything. So this is the impact to the overall portfolio. And I mentioned that our R, or risk, when we buy something, we calculate it, that worst case we get stopped out is going to be a minus 0.2% of the overall portfolio. And what we're striving to do is we want our wins to be 2 times this. So we want to be plus 0.4 when we close it out. That's ideal. Some of them are going to be much bigger. Take, for example, this Apple that we've been holding for a while is up 2.8%. So that's 14R is what we're up on that. Here's another one. This piece of DocuSign is up 0.54. We're up 0.2. So these are this is 3-to-1. This is a little over 2.5-to-1 on this piece of DocuSign. So what we've got over here is we want to calculate what are our stops. Okay, and this is 4 examples of it, starting with 618, and then it's been updated. This is as of the close today. So if all of our stops got hit, our drawdown should be approximately 3.99% off the high. So for $1 million portfolio, you would be stopped out at $962,800. That's a lot better than not knowing where you are if something, for example, like COVID would hit again. Suppose this Delta variant kicks up and the market starts selling off again, we know we're going to be out with a minimal loss. So on 618, that $1 million account was around 963,000. The total drawdown at that point was 3.09%, which would have brought the balance down to 933. So as you gain money in your balance, you want to see the balance at risk. If it stays stable, you want to see what your maximum drawdown is going to be. Just go higher. So the minimum on the portfolio has gone from 933 to 941 to 958 to almost 963. So you calculate your stops, you multiply it by the weight of the holding. This is what the drawdown would be. This is the percentage balance at risk of the overall portfolio. And if you add all these up, it comes to minus 3.99%. If you're in green here, this means our stop is above our entry, so we're not going to lose anything on that entry point. And let's apply this to our latest buy off of the 21/21 list, SE. I saw today that it was in its 3rd day of a below volume pullback down near the 21-day exponential moving average. We took first a 4% size on it and then added closer to the close as we got up 2%, another 2%. So that's up to a 6% size. And let's take a look at where our stops are going to be on that. So the 4% size, the stop is going to be, so here's the entry point here. We bought at 280.30 and then 285.77. The first stop is going to be at 267.20. On the second one, it's going to be 279. So the combined at risk is 0.28% and 0.6. We're up 0.11 combined on it altogether between the two buys. So 11 minus 34 puts us between 0.2 and 0.25, which is we aim for 0.20. We'll give it to 0.25 as a little bit of leakage. You don't always get your stop when you want to be stopped out. So let's take a look at the chart and where we got in. 280 and 286 on SE. The 21-day exponential moving average is at 273, and I just mentioned where the stop is on the first part and the second part. Second part, tighter stop, should hold the ADMA. As you can see, it kind of obeying it, and this has been going on with a lot of leadership stocks as they ride up. Let's take a look at some of the things that we own, like DocuSign has just been riding the 8 EMA higher. Let's look at NVIDIA, another example of a couple tests of the ADMA, but it's just riding it higher. So with the action that's going on in the market right now, if these start breaking the ADMA, that's going to be a changing character. So a lot of these stops are just below 1 to 2% below the ADMA. Let's also look at NET. This is another one that's been riding the 8 EMA higher. CrowdStrike riding the ADMA higher, one little break above, but we finished right on it and then followed through to new all-time highs. So as long as the leaders keep acting like this, we've got our stops in place. Should we get stopped out on everything, it'll be a 4% approximate drawdown from where we are right now. Again, that's not a guarantee. That's our estimate. If there's a huge gap down in the market for one reason or another, we're going to apply our rules to taking off the various positions. If you have any questions on that, I'd be glad to answer them. As always, you can reach out to me on Twitter at dvandenbord, email don@reveraasset.com, or call 855-REAL-WEALTH. Wrapping up Tuesday, June 29th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.